Good morning, everyone. You are watching live Daily Market Outlook from the brokers for Monday, 24th of December 2012, the day before the holiday starts, the last working day before Christmas holidays. The market start the week approximately at the levels where they ended last Friday, with dollar still being well supported as the main issue and concerns and fears about U.S. Fiscal cliff trigger fresh risk aversion that pushed the greenback against most of the majors. The single currency closed the week below 132 psychological level, still being in the corrective mode of strong barrier at 133.00. That there was a double failure last week on attempt to break this level, and easing as low as 131.57. This was the last Friday's low, with the market starting the European session still below 132 level. British pound is also at the back foot following last Friday's sharp fall below 162.00. That ended up at 161.40. Retraced approximately 50% of the latest uplink from 160 to 163. Again, 163 proved to be quite a tough barrier. Pardon. The main winner is again US dollar against Japanese yen, as it's again attacking its upper boundary of a recently established range that is capped at 83.60 and supported at 83.80, still moving in the range, but said the pair is currently attacking the upper boundaries and looking for possible stretch higher as Prime Minister-elect Abe keeps his pressure on the Bank of Japan to go for more aggressive policy and put the inflation target at 2%. As we said, the main issue is still the U.S. Fiscal cliff, and the wheels could come off the U.S. economy even before it has shifted out of second gear, unless politicians reach a last-minute deal to avoid the 600 billion in tax rises and spending cuts that kicks in next month. The rest of the world would be unable to avoid the pileup if America does fly off the so-called fiscal cliff, and that's why even on a holiday shortened weekend, the eyes will be peeled for signs that Democratic President Barack Obama and his divided Republican opponents can bury the hatchet. The White House on Friday tried to rescue the stalled talks, but there was a little headway to resolve what Alan Blinder, economics professor at Princeton University, called the biggest near-term risk facing the global economy. Seen from abroad, U.S. policymakers were looking clownish. The former vice chairman of the Federal Reserve said that this will do us a tremendous amount of damage. Until last Thursday, market has assumed the compromise would be struck, averting the risk of relapse into recession, but the slow motion car crash had been so well signaled that surely the drivers would swerve in time. But after Republicans abandoned the fix proposed by House of Representatives Speaker John Boehner, businesses and the households head into the year, and knowing the clarity they crave on tax and the spending plans could be weeks away. The longer uncertainty persists, the greater the negative impact on the economy is going to be expected, and basically so far they are running out of running away basically from any deal, though the President Obama still holds its optimistic point that he said that they might reach the agreement by the end of the year. Otherwise, as I mentioned previously in previous sessions and today, quite catastrophic impact of the U.S. sliding into fresh recession, of course, will hit most of the world economies. And this is still going to be due, despite the holidays and the lower volumes in the market. This is still going to be number one issue in the world markets. Of course, with the not finding the deal, it could be quite bad for the United States and of course for the rest of the world. Some analysts making the forecast for year 2013 said that there will be certain delay still more into the 2013, but finally the agreement will be found, as the part position like it is now doesn't suit any of the sides. It seems that they are just checking their prices, and finally they will give way and find some compromise to solve the current problem that could have quite good consequences, quite big consequences and negative consequences for us, America, as well as the rest of the world. As we are entering the holiday season, the markets are expected to have some lower volumes, especially on today, that U.S. session will be shortened by early closing of a number of instruments, but still movements are evident in the markets as most of the traders are heavily in due to the current situation and the fears that are growing about the U.S. fiscal cliff. As we don't have calendar for today, no releases basically. We're gonna jump into the technicals and see the latest movements and expectations for the coming trading day, as markets will be shut tomorrow, and most of markets except US will be shut also on the Boxing Day, 26th of December 2012. We are starting with the euro against the dollar. As we can see on the 4-hour chart, the bulls, near-term bulls, are running out of steam following the pullback from 133.00 and repeated attempt at stalled at 132.93, seeing more potential towards the downside so far. Good support, I mentioned it in the previous sessions, at 131.40.25. This is the previous high of 5th of December, and 131.40 is the 38.2% Fibonacci retracement of the upleg from 128.76 to 133.07, as well as 55 days exponential moving average that offers good support for now. Ideally, the market the pair should find the support here, as hourly studies are improving, gaining some bullish momentum, with MACD still below the midline but attempting higher. Immediate barrier we have currently attempting at 132, which is psychological barrier, and as well as 55 days, hourly 55 days exponential moving average, break of which is to open way for some stronger recovery. A significant barrier is at 132.30, which marks the previous high of last Friday, the intraday high of last Friday, as well as 50% retracement of the pullback from 133.07 to current low at 131.57, and break above here, and the 132.50 that marks 61.8% retracement is required to shift the focus higher again for possible renewed attempt at a strong 133 barrier. Failure to regain 132.30 keeps the risk of fresh weakness, lower top, and the fresh weaknesses. 4-hour structure is quite negative at this point, losing momentum, and the 20 days exponential moving average so far limiting the downside, as indicators are attempting below their midlines. Most of them, some of them are already in that position, seeing more potential at this point for further reversal of the latest upleg from 128.76 and the larger rally of the euro dollar from 120.42. That is a yearly low posted on 24th of July, that so far peaked at 133.07. This is the recent high. As said, 4-hour indicators, 4-hour situation is still favoring the downside, unless we are we regain 132.30.50. We might see fresh stretch lower through 131.40 to focus another significant support at 131.00. This is round figure, and the 50% retracement of the upleg from 128.76 to 133.07. Current risk aversion sees from that side sees more pressure on the single currency, as dollar became the safe haven instrument in the current fears and the uncertainty about U.S. fiscal cliff. And a similar situation is shown on the cable, where the pair dipped sharply last Friday, close to the end of the session, to hit low at 161.40, following two unsuccessful attempts to clear a strong barrier and the longer-term range top at 163.00. Base there is attempting base attempting at basing attempt, pardon, at 161.40. Yes, the pair jumps at the beginning of the day today and from Asian session and now continuing in the European session. So far at 161.87, approaching a psychological 162 barrier that is reinforced by 38.2% retracement of the down leg from 163.05 to 161.40. A larger picture is still holding a negative tone as shown on the 4-hour chart, as most of indicators are still in the negative territory, but reversal is evident on the stochastic and the momentum 14 that is currently attempting above the 7 days moving average, still in the negative territory, while RSI is breaking its moving average, seeing potential for some corrective action. I would say nothing serious to be expected unless we have a clear break above 162 and regain of minimum 162.40. That marks 61.8% retracement. The regain of this level is required to turn focus towards the upper boundaries and avert immediate downside risk. Otherwise, risk of a lower top and a fresh leg lower is seen as a likely scenario. As if we apply the wave principles, then we can see that the pair is currently in the fourth corrective wave, 1, 2, 3, fourth, that could travel up to 62, 162.20, and then the fifth wave should be extending down below 161.40, approximately to 161.00. That acts also as psychological support, and these are the lows of mid-December 2012, break of which again is set to confirm the double top at 163 zone and the open way for further reversal, as double top is acting as a bearish formation. From the larger picture, the bulls are still intact, although the stochastic reversing on the daily chart could be a signal of stronger reversal that was initially signaled by Gravestone doji candle left on 19th of December, and basically reversal from 163.00 could extend as low as 161, probably down to 160.00. That will mark the full retracement of the latest top leg and shift the focus towards the downside. Weekly structure shows that we are at the upper boundary of the larger range that is capped by 163.00, and basically break above this level is required to resume higher, and the breakout of the range with the 164 and 164.80 trendline resistance seen on the upper side as immediate targets. Back to the near-term structure, as we said, hourly indicators are improving at this stage, and if we see the gain of first of all 38.2% at 162.00 as initial barrier, reinforced by descending a 55 days exponential moving average currently to 162.09, then we can talk about some stronger recovery. Otherwise, a reversing scenario is seen quite likely, and as we said, according to the wave principles, the pair slide could travel as low as 161.00. The dollar yen is again supported by positive fundamentals, with gap higher opening seen today at 84.38 versus the last Friday's closing at 84.25, seeing more potential towards the upside. Hourly studies are positive and all pointing higher, with the 4-hour structure again showing some improvements, seeing potential, I would say, for a possible attack at 84.61. that is the recent 84.50 and 84.61, the recent highs, and our key barriers en route towards 85.00 that marks 200 days weekly 200 days moving average. The hourly structure, as we said, is still positive, with the 10 days exponential moving average holding the downside at 84.30 with a very bullish crossover of 20 over 55 days. Moving averages underpinning the action. Only break below 84.80, that is a recent base, and the double bottom could trigger some stronger reversal. And then we have 84.60, 84.30, and pardon, 83.60. I do apologize. 83.60, 83.30, and 83.00, 83.16 is the 50% retracement, and the 83.00 is psychological support, and the previous range top very strong support. Loss of this level is basically seen as a bearish trigger for some stronger corrective action. So far, the dollar yen looks like in the consolidative rather than corrective mode, with 83.80 holding the downside firmly for now, and the pair showing a scope for a fresh extension higher and possible retest of 84.50 and 84.61 following the recent flow of the traders' money from other assets into the safe haven US dollar. And finally, dollar Swiss recovery attempt of recent low at 90.81 shows signs of weakness despite breaking initial barrier at 91.50. Still the gains were so far short-lived. The 91.76 seen so far on last Friday's trading, and again fresh weakness is emerging out of these levels, with the hourly studies losing their initial bullish momentum, and the 4-hour indicators still holding below their midlines, and all starting to point higher, with the descending 55 days exponential moving average currently at 91.84, so far limiting the upside. As we said in the previous sessions, we need to see the clear break above 92 and 92.40 in order to pick up recovery and improve the current, bring more optimism into the current situation, although the pair remains still heavily pressured following its recent heavy losses that lost larger range floor at 92.14, 92.00, and so far a loss of 91 as psychological support, dipped to 90.81, threatening of further stretch lower as a part of the larger pullback from yearly peak at 99.70 that so far reached on the weekly chart, reached support at 90.76, whereas the 90 days weekly 90 days moving average, with the scope seen still for further weakness as daily studies remain firmly negative for now, and any bounce higher could be seen just as corrective as long as we are holding below 92 and 92.40 strong resistance zone. The yellow metal shows some signals of recovery following recent sharp losses down to 16.35, where there is attempt of double bottom, leaving double bottom on the recent bounce to 16.65 so far. Basically, the yellow metal retraced so far over 38.2% of the down leg from 1700 to 1635. Though still, this is still could be described as a corrective action, with the more optimism seen as investors are moving into gold again, following uncertainty about U.S. fiscal cliff. Technicals are positive on the hourly chart, with the 4-hour indicators now pointing higher, although the MACD is still well into the negative territory. Initial regain of 20 days exponential moving average sees a lot of work ahead in case we see the further extension higher, as 1684 previous lows and 1700 as psychological barrier are still keeping the upside limited. The break above these levels is required to signal further improvement and possibly to open way for stronger recovery. Otherwise, we also have the descending bear trend line of 1752 zone that is currently standing at approximately 1700 levels, and the break above 1700 as psychological resistance could be seen as a trigger for some stronger recovery. Otherwise, fresh risk towards the downside remains firmly in play. basically the pairs weekly close below 200 days moving average, despite current break higher sees more downside risk, and as we said, a corrective action could travel up to somewhere 1676, which is previous supports. Fibonacci expansion 61.8% of the down leg from 1752, 1684 the previous lows before the bears reassert and commence a fresh leg lower, with our initial target still being in play at 1630. That marks 100% Fibonacci expansion of the wave, third wave from 1752, and basically this is also the equivalent of the wave 1 length of wave 1 from a 1795 yearly peak to a 1672 low of 5th of November 2012. As said, more pressure is seen on the yellow metals near-term structure, as daily studies remain fairly negative, and any movements higher that will be capped by 1700 could be described as corrective ahead of fresh extension lower. In case of a break below 1630 zone, we have immediate support at 1600 as as a round figure support, and then Fibonacci expansion 138.2% at approximately 1588. That is equivalent to the previous lows of month of August 2nd and 14th of August 1590 and 1585, ahead of a more significant 1548 low of 28th of June. That is approximately 161.8% Fibonacci expansion. That stands at 1551. And finally, the crude oil, some corrective action on the recent gains is seen in the past couple of sessions, following a stretch to 90.52 last Thursday, where the gains were up again, failing to clearly break 90.31, pardon, previous highs at 90.42, 38.2% Fibonacci retracement, as shown on the daily chart. Also the daily 90 days moving average with subsequent reversal, pullback, reversing so far approximately. Let's take a look on the Fibonacci levels. Nearly 50% of the down leg from the up leg from 85.20 to 90.52, with the near-term bulls coming under threat, as 4-hour chart indicators are now sliding into the negative territory and seeing more pressure towards the downside, with 55 days exponential moving average so far containing dips, but from the other side crossing a bearish crossover of 10 over 20 days. One sees additional pressure along with the indicators that are sliding into the negative territory. Immediate risk is seen on a break below last Friday's low at 87.95. In previous sessions I mentioned 88 as a good support and expected the price to be contained there, and the reverse as seen as ideal reversal point. So far more pressure is still seen towards the downside unless we break above 89.00 as initial barrier and the moving averages crossover. We might expect more pressure and risk towards the downside, especially that dollar is getting boosted in the past a couple of sessions. That impacts, of course, the energy price as loss of 88 support, sees 87, 86, 50% retracement, and 61.8% at 87.23. Basically break below 87 would again shift focus towards the lower boundaries and supports. We have 86.50 as 76.4% retracement, at 86.00 as around the figure support. Daily structure as for the crude oil is still holding a positive tone as indicators broke higher, but reversal of RSI and the stochastic, that is early indicator, sees increased downside risk. Basically the price action is now stuck between 55 and 90 days moving average on the daily chart, and the loss of support at 87.89. That underpins the 88 support. Could see further retracement of the latest rally from 85.20 to 90.31, and bring the pair, confirm the pair returned back to risk and of course confirm the top again at 90.50, seeing that recent range is still being capped, and no progress towards the upside could be expected. That was all from me for today, 24th of December 2012. I guess you have no questions for today, unless if there is one, then you can submit your questions now, as we are already entering the holidays and the Christmas mood. Still we can discuss about the most important things. Thank you. Okay, there are just Christmas wishes. Thank you. Same to you. Merry Christmas, and I wish you very nice and happy holidays. Okay, it seems that we have no questions for today, and we are going to conclude our session again. Thank you again. There is another message. Thank you again for being with us. I wish you very nice Christmas holidays, nice and relaxing with your families, as it always goes. And we'll be back on Friday, which is 28th of December. This is our next scheduled session. We'll see what situation we'll have there. Not to expect some higher volumes during the holidays, holiday season. These couple of days. We're ending our today's session. I wish you a very nice day today, and of course, very nice Christmas. And we'll be back on Friday, 28th of December 2012. Good luck.